Loans are a fundamental part of our financial system, allowing individuals and businesses to borrow money to achieve their goals. But with so many types of loans available, it can be confusing to know which one to choose. Hello and welcome to Finance Capital Advisory. In this video, we'll explore the world of loans and help you understand everything you need to know to make an informed decision. Let's start with the most common type of loan, the credit card. Credit cards can be a convenient way to pay for purchases, but they also come with significant drawbacks. High interest rates and the potential for overspending can lead to a cycle of debt that's difficult to escape from. If you are not careful, the interest and the fees on a credit card can quickly spiral out of control, leaving you in a much worse financial situation than before. Personal loans, on the other hand, are a type of unsecured loan that can be used for a variety of purposes. They typically have lower interest rates than credit cards and can be a good option for consolidating debt or financing a large purchase. When applying for a personal loan, it's important to shop around and compare rates from different lenders. Make sure you understand all the fees and charges associated with the loan, including origination fees, prepayment penalties, and late fees. If you're in the market for a new car, you might consider an auto loan. These loans are secured by the vehicle itself, which means that if you default on the loan, the lender can repossess the car. Auto loans typically have lower interest rates than personal loan because they are less risky for the lender. However, you will need to have a good credit score and a steady income to qualify for a car loan. You'll also need to make a down payment, which can be as much as 20% of the car's purchase price. For small business owners, a business loan can provide the funding needed to get off the ground or expand operations. These loans can be secured or unsecured and may require a business plan and financial statements to be approved. Secure business loans require collateral, such as inventory or equipment, while unsecured loans don't require collateral but typically have a higher interest rate. It's important to have a solid business plan and a good credit score when applying for a business loan. Now, we come to the largest and most significant loan that the most people will ever take out, the mortgage. Mortgages are used to purchase homes and are secured by the property itself. They typically have lower interest rates than other types of loans but require a significant down payment and a good credit score to qualify. When applying for a mortgage, you will need to provide a lot of documentation, including pay stubs, tax returns, and bank statements. You'll also need to have a good debt to income ratio, which is the amount of debt you have compared to your income. Regardless of the type of loan you choose, it's essential to read the terms and conditions carefully and make sure you understand all the costs associated with borrowing. Late fees, prepayment penalties, and other charges can add up quickly, so it's important to be aware of them before you sign on the dotted line. You should also consider the overall impact that a loan will have on your finances. Can you afford the monthly payments? And how will the loan affect your debt to income ratio? Make sure you have a clear plan for how you'll repay the loan and factor that into your budget. One important factor to keep in mind is your credit score. The credit score is a number that represents your credit worthiness and is based on factors such as payment history, credit utilization, and length of credit history. Lenders use your credit score to determine your interest rate and whether or not you are eligible for a loan. If your credit score is low, you may need to take steps to improve it before you can qualify for a loan with favorable terms. Another factor to consider is the lender you choose. Different lenders offer different rate, fees, and terms, so it's important to shop around and compare options. Banks, credit unions, and online lenders are all options to consider, but make sure you choose a reputable lender with a track record of fair lending practices. Once you have chosen a lender and been approved for a loan, it's important to make your payments on time and in full. Late payments can damage your credit score and lead to additional fees and charges. If you are struggling to make your payments, contact your lender right away to see if they offer any options for deferment, forbearance, or loan modification. Loans are a powerful tool for achieving your financial goals, but they also come with risks and responsibilities. By understanding the different types of loans available, shopping around for the best rates and terms, and being responsible with your borrowing, you can use loans to build a better financial future for yourself and your family. Before taking out a loan, it's important to consider your reasons for borrowing. Are you taking out a loan to make a large purchase, such as a home or car, or are you using the loan to consolidate debt or pay the unexpected expenses? Understanding your reasons for borrowing can help you choose the right type of loan you need. There are several types of loans available, including personal loans, auto loans, home loans, and student loans. Personal loans are unsecured loans that can be used for any purpose, while auto loans and home loans are secured loans that are specifically designed for those purchases. Student loans are another type of loan that can be used to pay for education expenses. When it comes to secured loans, such as auto and home loans, the lender will typically require collateral, such as the vehicle or property. In case you are unable to repay the loan, this can make secured loans a bit more complicated than unsecured loans, but they often come with lower interest rates and more favorable terms. When applying for a loan, you will need to provide information about your income, employment history, and credit score. Lenders use this information to determine your creditworthiness and to assess the risk of lending to you. If you have a good credit score and a stable income, you will be more likely to be approved for a loan with favorable terms. Once you have been approved for a loan, it's important to carefully review the loan documents before signing. Make sure you understand the interest rate, fees, and repayment terms, and ask any questions you may have. Don't be afraid to negotiate with the lender to get better terms, such as lower interest rate or longer repayment period. It's important to have a plan for repaying the loan. Create a budget that includes the loan payment and make sure you can afford the monthly payment before taking out the loan. If possible, consider paying more than the minimum payment to pay off the loan faster and reduce the total amount of interest you will pay. One important aspect to consider when taking out a loan is the interest rate. The interest rate determines the cost of borrowing and can significantly impact the total amount you will pay back over the life of the loan. When shopping for loans, compare interest rates from different lenders and choose the option with the lowest rate. It's also important to consider the length of the loan term. Longer loan terms can result in lower monthly payments, but they also mean you have to pay more in interest over time. Shorter loan terms typically come with higher monthly payments but can save you money in the long run. If you are unsure which type of loan is right for you, consider consulting a financial advisor. A financial advisor can help you understand your options and determine which loan best fits your financial goals and circumstances. Finally, it's important to be responsible with your borrowing. Only borrow what you can afford to repay and avoid taking out loans for unnecessary expenses or purchases. Make your loan payments on time and in full to avoid additional fees and damage in your credit score. Keeping track of your credit score is also important when it comes to borrowing. You are entitled to a free credit report from each of the 3 major credit reporting agencies once a year. So take advantage of this and monitor your credit score regularly. If you notice any errors or discrepancies, report them right away to have them corrected. Thanks for watching, and we hope the video has been informative and helpful. Remember, loans can be a useful tool for achieving your financial goals, but they also come with risks and responsibilities. By understanding the different types of loans available, shopping around for the best rates and terms, and being responsible with your borrowing, you can use loan to build a better financial future for yourself and your family. Whether you are opening your first bank account or considering a change, understanding the different types of accounts is crucial. There are various types of bank accounts. The first type of bank account is a checking account. This account is designed for day-to-day transactions and allows you to deposit and withdraw funds as needed. Checking accounts usually come with a debit card, allowing you to access your funds at ATMs and make purchases. Some banks also offer overdraft protection, which allows you to overdraw your account up to a certain limit, although this service may come with fees. The second type of bank account is a savings account. This account is designed to help you save money over time. Savings accounts usually offer high interest rates than checking accounts, making them a good option for long-term savings. However, saving accounts typically have limits on the number of withdrawals you can make per month. The third type of bank account is a money market account. This type of account is similar to a savings account but usually offers even higher interest rates. Money market accounts may also come with check writing privileges, but again, there are usually limits on the number of withdrawals you can make each month. The fourth type of bank account is a certificate of deposit or CD. This is a type of deposit account that requires you to deposit a sum of money for a fixed period, usually ranging from a few months to several years. In exchange for this commitment, CDs offer higher interest rates than most other types of accounts. However, you cannot withdraw your money before the maturity date without incurring a penalty. Finally, the fifth type of bank account is a joint account. This type of account is opened by two or more people, such as spouses or business partners. Joint accounts can be checking, savings, or any other type of account, but they provide each account holder with equal access to the account's funds. Opening a bank account is a crucial first step in managing your finances. To get started, you need to gather the necessary documents, such as your government-issued ID, proof of your address, and social security number. Once you have these documents, you can head to a local bank or credit union to open your account. You will need to fill out an application and your bank will likely run a credit check. It's important to be honest on your application, as misrepresenting yourself can have consequences. Some common mistakes to avoid when opening a bank account include not understanding the fees associated with the account, not reading the terms and conditions, and not keeping track of your balance. Financial terms can be confusing, but understanding them is essential to managing your money. One key term to know is interest rate, which is the amount of money a bank pays you for holding your money in an account. Another important term is annual percentage rate (APR), which is the rate of interest you pay on credit card balances or loans. Overdraft fees are another term to know, as they can be costly if you accidentally overdraw your account. It's also important to understand the difference between simple interest rate and compound interest. Simple interest is calculated based on the principal amount, while compound interest is calculated based on the principal amount plus any interest earned. By understanding these terms, you can make informed decisions about your money. Managing your money is essential to your financial well-being. One key successful money management is setting financial goals. Whether it's saving for a vacation or paying off debt, having clear goals can help you stay motivated and focused. Creating a budget is another important step. A budget can help you keep track of your income and expenses and help you identify areas where you can save money. Automating your savings can also be helpful. Setting up automatic transfers from your checking account to your savings account can help you save money without even thinking about it. Finally, it's important to avoid unnecessary fees such as ATM fees or overdraft fees, which can add up over time. Online banking is a convenient way to manage your money. Most banks offers online banking services that allows you to check your account balance, transfer money, and pay bills from your computer or mobile device. Online banking can be a great way to save time and stay on top of your finances. However, it's important to be careful when using online banking. Make sure to choose a strong password and enable two-factor authentication to protect your account from unauthorized access. It's also a good idea to avoid using public Wi-Fi when accessing your bank account, as these networks can be insecure. Your credit score is an important factor in your financial health, as it can impact your ability to get a loan or credit card. Credit scores are calculated based on several factors, including your payment history, amount of debt, length of credit history, and types of credit used. To improve your credit score, make sure to pay your bills on time and keep your credit utilization low. When it comes to loans, there are many different types available, such as personal loan, auto loans, and home loan. It's important to shop around for the best interest rates and terms, and to read the fine print before signing any loan agreement. Bank fees and charges can eat into your savings if you're not careful. Some common fees to watch out for include ATM fees, overdraft fees, and monthly maintenance fees. To avoid these fees, consider using your bank's ATM or signing up for a no-fee checking account. You can also opt out for overdraft protection to avoid costly fees if you accidentally overdraw your account. Finally, consider negotiating with your bank to reduce or waive fees. Many banks are willing to work with customers to keep their business. Investing in retirement accounts can help you build wealth over the long term. Retirement accounts like 401ks and IRAs offer tax advantages and can help you save for your golden year. It's important to choose the right type of retirement account for your needs and to contribute as much as you can afford. When it comes to investing, there are many different options such as stocks, bonds, and mutual funds. It's important to do your research and choose investments that align with your risk tolerance and financial goals. Unfortunately, fraud and identity theft are common in the banking world. To protect yourself, it's important to be vigilant and take steps to safeguard your personal information. Some tips to avoid frauds include not giving out your social security number or other personal information to anyone you don't trust, monitoring your accounts regularly, and being wary of the suspicious emails or phone calls. If you suspect fraud, contact your bank immediately to report the issue and get help. Digital banking services are becoming more popular and can offer convenient ways to manage your finances. Some examples of digital banking services include mobile banking apps, online bill pay, and digital wallets. These services can make it easier to keep track of your money and make transactions. However, it's important to be cautious when using these services to protect your personal and financial information. Small business owners may have different banking needs than individuals. Small business banking services can include checking accounts, saving accounts, loans, and lines of credit. It's important for small business owners to choose a bank that understands their unique needs and can provide the right services and support. If you travel frequently or do business internationally, you may need to use international banking services. These services can include foreign currency accounts, international wire transfers, and international credit cards. It's important to be aware of exchange rates and fees when using international banking services, and to choose a bank with a strong international presence and good customer support. Some banks are committed to environmental and social responsibility and may have policies in place to support sustainability and social causes. If this is important to you, consider choosing a bank that aligns with your values and has a strong track record of social and environmental responsibility. Finally, it's important to consider the level of customer service and support offered by your bank. Look for a bank with good customer reviews and a responsive customer support team. You may also want to consider factors such as the bank's hour of operation, accessibility, and online resources. By considering all of these factors and choosing the right bank and banking services for your needs, you can manage your finances more effectively and make the most of your money. In conclusion, by understanding the different types of bank accounts, financial terms, managing your money, credit scores, loans, bank fees, investing, retirement accounts, fraud protection, digital banking services, small business banking, international banking, environmental and social responsibility, and customer service and support, you can make informed decisions about your finances and choose the right bank and banking services for your needs. Remember to always be vigilant and protect your personal and financial information when using banking services. Real estate is also a dynamic and ever-changing industry. New technologies, changing demographics, and shifting economic trends are constantly reshaping the way we think about real estate. From the rise of green building to the growing demand for affordable housing, real estate is a reflection of our values and aspirations as a society. Of course, for most people, real estate is all about finding the perfect home. Whether you are looking for a cozy bungalow or a sprawling mansion, buying a home is one of your biggest decisions you'll ever make. It's a decision that requires careful consideration of your finances, your lifestyle, and your personal values. But real estate is also about much more than just buying and selling homes. Commercial real estate is a vital part of our economy, providing space for businesses of all sizes to operate and grow. From downtown office buildings to suburban shopping centers, commercial real estate plays a critical role in shaping the way we work and do business. Real estate is also a driver of economic growth and development. Real estate developers are the masterminds behind the construction of new homes, commercial buildings, and infrastructure projects that transform our communities through careful planning and innovative design. Real estate developers are helping to build the cities and towns of the future. But perhaps most importantly, real estate is about people. It's about the families who make a house a home, the entrepreneurs who build businesses from the ground up, and the developers who envision and create the spaces that bring communities together. Real estate is about the dreams and aspirations of millions of people around the world. So whether you're a buyer, a seller, an investor, or a developer, real estate is a world of endless possibilities. It's a world where the sky is the limit and where anything is possible. So go out there and explore the world of your real estate. Who knows, you might just find your dream home, your next great investment, or your calling as a real estate developer. The possibilities are truly endless. But to succeed in the world of real estate, you need more than just dreams and aspirations. You need knowledge, skills, and a willingness to learn. That's why real estate conferences, seminars, and training programs are so important. They offer you the opportunity to network with industry experts, learn about the latest trends and technologies, and gain the skills you need to succeed. Real estate investing is a prime example of an area where knowledge and skill are critical. Successful real estate investors need to have a deep understanding of finance, market trends, and property management. They need to be able to analyze financial reports, assess risks, and make informed investment decisions. Real estate agents, on the other hand, need to be skilled in sales, marketing, and customer service. They need to be able to connect with clients, understanding their needs, and help them find the perfect property. They need to be able to use the latest technologies and tools to market properties and close deals. Real estate development requires a different set of skills altogether. Developers need to be able to navigate complex regulations, secure financing, and manage construction projects. They need to be able to work with architects, engineers, and contractors to turn their vision into reality. But no matter what area of real estate you are in, one thing is certain: it's a people-driven industry. Successful real estate professionals need to be able to connect with clients, build relationships, and understand their needs. They need to be able to communicate effectively, negotiate deals, and build trust. That's why conferences like this one are so valuable. They offer you the opportunity to connect with other real estate professionals, share ideas, and learn from industry experts. They give you the tools and resources you need to succeed in this dynamic and ever-changing industry. So whether you are a first-time home buyer, a seasoned investor, or a real estate developer, remember that real estate is more than just buildings and land. It's about people and the dreams and aspirations they bring to the table. So go out there and make your mark on the world of real estate. The possibilities are truly endless. Real estate is a tangible asset that has been a source of wealth for many individuals and families throughout history. It's an investment that can provide passive income, appreciation, and tax benefits. However, investing in real estate can also be risky, and it's important to do your due diligence and seek professional advice before making any investments. One of the ways people invest in real estate is through property auctions. These auctions offer properties at below market price, but they also come with their own set of risks. It's important to thoroughly research the property, its history, and its potential before bidding at an auction. Property management is another important aspect of real estate investing. Property managers oversee the day-to-day operations of rental properties, including rent collection, maintenance, and tenant screening. Hiring a professional property manager can help ensure your investment runs smoothly and efficiently. Luxury real estate is a niche market that caters to high-end clients who are looking for unique and exclusive properties. Luxury real estate agents need to be experts in marketing and sales, and they need to be able to connect with affluent clients and understanding their lifestyle needs. Commercial real estate involves the purchase, sale and lease of properties used for business purposes, such as office buildings, retail spaces and industrial facilities. Commercial real estate investors need to be able to assess the potential income and expense of a property as well as its market demand and location. Real estate development is the process of turning raw lands into a developed property. Developers need to be able to navigate the zoning and permitting process, secure financing, and manage construction projects. They also need to be able to assess the market demand for a particular type of property and create a development plan that meets that demand. At the end of the day, real estate is about more than just buying and selling properties. It's about finding a place to call home, building wealth, and creating communities. Whether you're a buyer, seller, investor, or developer, real estate offers a world of possibilities and opportunities. For many people, buying a home is a major milestone and a significant financial decision. As a first-time home buyer, it's important to do your research, understand your budget and financing options, and work with a knowledgeable real estate agent who can guide you through the process. Real estate investing can provide opportunities for short-term profits through property flipping or long-term gains through rental properties. However, it's important to carefully assess the potential risks and rewards of any investment and to have a solid understanding of the local market and the property's potential. Real estate transactions involve complex legal and financial issues, and it's important to work with a skilled real estate lawyer who can help protect your interests and ensure a smooth transaction. Real estate lawyer can assist with drafting and reviewing contracts, resolving disputes and addressing legal issues related to zoning and property rights. Real estate agents play a key role in helping buyers and sellers navigate the real estate market. They can provide valuable insights into local market trends, help buyers find properties that meet their needs and budget, and help sellers effectively market their properties and negotiate the best price. Real estate appraisers provide an objective assessment of the value of a property, which is essential for buyers, sellers, and lenders. Appraisers take into account a variety of factors, including the location, size, condition, and comparable sales of similar properties in the area. In recent years, there has been growing interest in sustainable and environment-friendly real estate development. Green buildings use energy-efficient materials and systems, reduce waste and emissions, provide healthier indoor environments for occupants. Real estate is constantly evolving industry, and it's important for professionals to stay up to date on the latest trends and technologies. Conferences, seminars, and training programs can provide opportunities for networking, continuing education, and professional development. At the end of the day, real estate is about people and their dreams. Whether you're buying your first home, investing in a rental property, or developing a new project, real estate is a powerful tool for creating wealth, building communities, and making a difference in the world. The real estate market can be affected by a variety of factors, including economic conditions, interest rates, government policies, and consumer behavior. Understanding these factors can help buyers, sellers, and investors make informed decisions and navigate the market successfully. Real estate transactions can be emotional and stressful, and it's important to work with an agent who is experienced, professional, and compassionate. A good agent can help you stay focused on your goals, navigate the complexities of the transaction, and advocate for your interests. Real estate investment trusts are a type of investment that allow individuals to invest in real estate without actually owning physical properties. REITs own and operate income-generating properties such as apartment buildings, office parks, and shopping centers, and investors receive a portion of their income generated by the properties. Real estate development involves a wide range of professionals, including architects, engineers, contractors, and construction workers. These professionals work together to turn a vision into reality, creating buildings and spaces that can transform communities and improve people's lives. Real estate investing requires a solid understanding of finance and accounting. Investors need to be able to analyze financial statements, understand tax implications, and manage cash flow effectively. Working with a financial advisor or accountant can help ensure that your investors are aligned with your overall financial goals. Technology has transformed the real estate industry, making it easier than ever to buy, sell, and invest in properties from anywhere in the world. Virtual tours, online listings, and digital marketing tools have made it possible for buyers and sellers to connect and transact business in new and innovative ways. Real estate auctions can be exciting and fast-paced, but they also require a certain level of expertise and strategy. Auctions are often used to sell distressed properties or properties with unique features, and bidders need to be able to assess the potential risks and rewards of each property. Negotiation skills are essential in real estate. Whether you are buying, selling, or investing, negotiating the best price and terms requires the ability to communicate effectively, understand the parties' needs and interests, and find creative solutions that benefit both the parties. Managing rental properties can be challenging but rewarding experience. Landlords need to be able to find and screen tenants, collect rent, and maintain the property in a good condition. They also need to be familiar with local landlord-tenant laws and regulations. Commercial real estate can offer significant financial rewards, but it also requires a different set of skills and knowledge than residential real estate. Commercial real estate agents need to be familiar with market trends, zoning and land use regulations, and unique needs of businesses. Mixed-use developments are becoming increasingly popular as they offer a combination of residential, commercial, and retail spaces in one location. These developments can revitalize urban areas, create vibrant communities, and provide convenient access to amenities and services. Real estate flipping involves buying a property, making renovations or improvements, and selling it for a profit. Flipping can be risky and requires a solid understanding of the local market and the cost of renovations. Successful flippers also need to be able to negotiate with contractors and manage the renovation process effectively. Buying a home can be one of the most significant financial decisions in a person's lives. Buying a home can be one of the most significant financial decisions in a person's life. First-time home buyers need to be able to navigate the home buying process, including finding the right property, securing financing, and negotiating the terms of the sale. Working with an experienced agent can help ensure a smooth and successful transaction. Real estate investing requires a thorough understanding of the local market and the factors that influence it. Investor needs to be able to analyze data, identify trends, and make informed decisions about where and when to invest. Conducting a market analysis can provide valuable insights into the current state of the market and the potential for future growth. High-end real estate transactions require a special set of skills and expertise. Luxury properties often come with unique features and amenities, and buyers and sellers may have specific needs and expectations. Working with a high-end real estate agent who's familiar with local market can help ensure a successful transaction. Real estate leasing involves renting out a property to a tenant for a specified period of time. Landlords need to be able to negotiate lease agreements, collect rent, and maintain the property in good condition. They also need to be familiar with the local leasing laws and regulations. In a competitive real estate market, buyers and sellers need to be able to act quickly and strategically. Bidding wars and multiple offers can be common, and working with an agent who's familiar with the local market can help you make informed decisions and stay ahead of the competition. Real estate development requires a solid understanding of architecture, engineering, and construction. Developer needs to be able to create a vision for the project, work with professionals to bring the project to life, and manage the construction process effectively. They also need to be familiar with zoning and land use regulations and the potential impact of their projects on the surrounding community. Real estate investing requires a thorough due diligence process, which involves assessing the potential risks and rewards of a property before investing. Investors need to be able to analyze financial statements, evaluate market trends, and assess the physical condition of the property. Conducting a thorough due diligence process can help investors make informed decisions and minimize the risk. With the right team by your side, your real estate dreams can become a reality. So why wait? Start exploring your options today and see what the world of real estate has to offer. Mutual funds are an incredibly popular and important investment option that can help you achieve your financial goals. In this video, we'll cover the basics of what mutual funds are, how they work, and the benefits and risks associated with investing in them. So let's dive in. At its simplest, a mutual fund is a pool of money contributed by multiple investors, which is managed by a professional fund manager. The fund manager uses the money to invest in various securities such as stocks, bonds, and money market instruments. When you invest in a mutual fund, you buy units of shares in the fund, which represent a portion of the overall pool of money. The value of these units or share rises or falls depending on the performance of the investments held by the fund. Mutual funds are regulated investment companies that are required to follow certain rules and regulations set forth by the Securities and Exchange Commission (SEC). These regulations are designed to protect investors by ensuring that mutual funds are managed in a transparent and fair manner. There are different types of mutual funds that cater to different investment objectives and risks profiles. For example, equity mutual funds invest primarily in stocks, while fixed income mutual funds invest primarily in bonds. Balanced funds invest in a combination of stocks and bonds, and index funds seek to replicate the performance of a market index. Mutual funds are typically open-ended, which means that new investors can join and existing investors can redeem their shares at any time. The prices of the units of shares is calculated daily based on the net asset value of the fund, which is the total value of all the assets held by the fund divided by the total number of units or shares outstanding. One of the primary benefits of mutual funds is diversification. By investing in a mutual fund, you gain exposure to a portfolio of securities that would be difficult or expensive to build on your own. This diversification helps to reduce risks as the performance of one security is unlikely to significantly impact the overall performance of the fund. Another benefit of mutual funds is professional management. The fund manager is responsible for making investment decisions on behalf of the investors based on their investment objectives and risk tolerance. This can be particularly helpful for investors who do not have time or expertise to manage their own investments. Mutual funds are relatively easy to buy and sell. You can invest in a mutual fund with as little as a few $100s, and you can redeem your shares at any time. This liquidity makes mutual funds a convenient and flexible investment option. While mutual funds can offer significant benefits, they are not without risks. One of the main risks is market risk, which is the risk that the value of the fund will decline due to a general decline in the securities market. This risk can be mitigated by diversification, but it cannot be entirely eliminated. Another risk is the management risk, which is the risk that the fund manager will make poor investment decisions, resulting in a decline in the value of the fund. While the professional management provided by mutual funds can be a benefit, it is important to research and select a fund manager with a strong track record and investment philosophy that aligns with your own. Mutual funds can offer a variety of investment objectives and risk profiles, depending on the needs of the investors. For example, investors who are seeking higher returns may consider investing in equity mutual funds, which invest primarily in stocks. On the other hand, investors who are seeking more stable returns may consider investing in fixed income mutual funds, which invest primarily in bonds. Balanced funds, which invest in a combination of stocks and bonds, can provide investors with a balanced approach to investing. One of the key benefits of mutual fund is professional management. The fund manager is responsible for making investment decisions on behalf of the investors, based on their investment objectives and risk tolerance. The fund manager's expertise and experience can be particularly helpful for investors who do not have time or expertise to manage their own investments. This can also be helpful for investors who want to take a more hands-off approach to investing. However, it's important to understand the risks associated with investing in mutual funds. Market risk is one of the main risks. as the value of the fund may decline due to a general decline in the securities market. This risk can be mitigated by diversification, but it cannot be entirely eliminated. One of the key advantages of mutual funds is that they provide investors with access to a diversified portfolio of securities. A mutual fund pools money from many investors and invests that money in a variety of securities. By investing in a mutual fund, an investor can gain exposure to a much broader range of securities than they would be able to if they were investing on their own. This diversification can help you to reduce risk, as the performance of one security is unlikely to significantly impact the overall performance of the fund. In addition to providing access to a diversified portfolio of securities, mutual funds also offer professional management. The fund manager is responsible for making investment decisions on behalf of the investors based on their investment objective and risk tolerance. The fund manager's expertise and experience can be particularly helpful for investors who do not have the time or expertise to manage their own investments. This can also be helpful for investors who want to take a more hands-off approach to investing. Mutual funds can have fees and expenses that can reduce your investment returns. These fees can include management fees, administrative fees, and other expenses associated with running the fund. It is important to understand the fees and expenses associated with a mutual fund before investing, as they can vary widely from fund to fund. Overall, mutual funds can be a great investment option for investors who want to gain exposure to a diversified portfolio of securities managed by a professional fund manager. Mutual funds provide investors with a range of investment objectives and risk profiles, and other professional management and liquidity. However, it's important to understand the risks associated with investing in mutual funds, including market risk, management risk, and fees and expenses. By doing your research and selecting a mutual fund that aligns with your investment goals and risk tolerance, you can take advantage of the benefits of mutual funds with minimizing the risk. One important thing to note about mutual funds is that they can be either actively managed or passively managed. Actively managed funds are managed by a professional fund manager who makes investment decisions based on the analysis of market trends, economic data, and other factors. The goal of an actively managed fund is to outperform the market and deliver higher returns to investors. Passively managed funds, on the other hand, are designed to track the performance of a particular index or benchmark, such as the S&P 500. These funds are not actively managed by a fund manager, but rather, the portfolio is structured to match the holdings of the underlying index. The goal of a passively managed fund is to outperform the market, but rather to deliver returns that closely mirror the performance of the benchmark. Both actively managed and passively managed funds have their own benefits and drawbacks. Actively managed funds can potentially deliver higher returns, but they also come with higher fees and expenses. Passively managed funds are generally less expensive, but they not be as well suited for investors who are looking for higher returns. Another important consideration when investing in mutual fund is the tax implications. Mutual funds can generate taxable income in the form of dividends and capital gains. If you invest in a mutual fund held in a taxable account, you may be subject to taxes on these income streams. However, there are some tax-efficient mutual funds available that are designed to minimize taxes for investors. It's also worth noting that mutual funds can be invested in through different account types, such as traditional IRAs, Roth IRAs, and 401k plans. The account type you choose can have implications for taxes and investment fees, so it's important to consider your options carefully and consult with a financial advisor if needed. Finally, when choosing a mutual fund to invest in, it's important to do your research and consider a range of factors, such as the fund's investment objective, historical performance, and fees and expenses. It can be helpful to consult with a financial advisor who can provide guidance and help you make an informed decision. In conclusion, mutual funds can be a great investment option for investors who want access to a diversified portfolio of securities, professional management, and liquidity. However, it's important to understand the risks and fees associated with mutual funds, as well as the different types of mutual funds available, including actively managed and passively managed funds. By doing your research and working with a financial advisor, you can make an informed decisions about which mutual fund is right for your investment. By doing your research and working with a financial advisor, you can make an informed decisions about which mutual fund is right for your investment goals and risk tolerance. So, what is inflation? Inflation is the rate at which the general level of prices for goods and services is increasing over time. In other words, it's the decline in the purchasing power of money. When inflation occurs, each unit of currency buys fewer goods and services than it did before. This means that it costs more to purchase the same goods and services than it did previously. One of the key causes of inflation is an increase in the demand for goods and services, which can result in the price increases as businesses compete for the limited supply of goods and services. Another cause of inflation is an increase in the cost of production, such as the cost of labor or raw materials. In addition, inflation can be triggered by a decrease in the supply of goods and services, such as during times of natural disasters or wars. Inflation can have both positive and negative effects on the economy. On the positive side, inflation can encourage spending and investment as people try to avoid the higher prices of goods and services in the future. This can help to stimulate economic growth and job creation. In addition, inflation can help you to reduce the value of public debt, making it easier for governments to pay off their debts. However, inflation can also have negative effects on the economy. One of the key negative effects of inflation is that it reduces the purchasing power of consumers, which can lead to a decrease in consumer spending and economic activity. In addition, inflation can make it more difficult for businesses to plan and invest, as they face uncertain costs and revenues. High inflation rates can also lead to economic instability and social unrest. The impact of inflation is felt most acutely by those on fixed incomes or with low wages, as they struggle to afford the basic necessities of life. Inflation can also contribute to wealth inequality, as those with more assets may benefit from the increase in the prices. Central bank plays a key role in managing inflation. They use monetary policy tools such as interest rates and the money supply to try to keep inflation within a target range. By increasing interest rates, central banks can reduce the demand for credit and slow down economic activities, which can help to manage inflation rates. By contrast, lowering interest rates can stimulate economic activity and increase inflation rates. It's important to understand that inflation rates can vary by country and region, and they can be influenced by a wide range of factors such as government policies, global events, and market conditions. In addition, inflation rates can impact different industries and goods and services in different ways. It's important to stay informed about the inflation rates and to adjust your financial planning accordingly. So what we can do to manage inflation? One of the key strategies is to save and invest wisely. By saving money, you can protect yourself against the effects of inflation by preserving your purchasing power. Investing in stocks, bonds, and other assets can also help to protect your wealth against inflation, as they may increase in value over time. Another strategy is to work with a financial advisor to develop a comprehensive financial plan that takes into account the potential effects of inflation. A financial advisor can help you to identify strategies to manage inflation, such as investing in inflation-protected securities or diversifying your portfolio to reduce risk. Finally, it's important to be proactive in managing your expenses. By shopping around for the best deals and being mindful of your spending, you can help to reduce the impact of inflation on your budget. In addition, it's important to be mindful of the impact of inflation on your income, particularly if you're on a fixed income or have a low-wage job. You may need to take steps to increase your income or reduce your expenses to ensure that you can afford the basic necessities of life. Inflation is an important topic that is studied extensively in economic classes around the world. Students learn about the different types of inflation, such as demand pull inflation and cost push inflation, as well as the different measures of inflation, such as the consumer price index and the producer price index. They also learn about the various policy tools that governments and central banks can use to manage inflation, such as adjusting interest rates and controlling the money supply. Central bank plays a critical role in managing inflation. In many countries, the central bank is responsible for setting interest rates, which can have a significant impact on the level of inflation. If the central bank believes that inflation is rising too quickly, it may raise interest rates to slow down economic activity and reduce inflationary pressures. Conversely, if the central bank believes that inflation is too low, it may lower interest rates to encourage spending and investment and to boost economic growth. Inflation can also have political implications, particularly in countries where inflation rates are high or unstable. High inflation can lead to social unrest and political instability as people struggle to afford basic necessities and become frustrated with the government's inability to manage the economy. In extreme cases, hyperinflation can lead to economic collapse and social upheaval, as we have seen in countries such as Zimbabwe and Venezuela. It's worth noting that inflation can also affect the supply side of economy when prices rise. Businesses face higher costs for labor, materials and other inputs, which can reduce their profit margins and lead to lower levels of investment and production. This in turn can lead to lower economic growth, reduced employment and higher levels of unemployment. Small businesses are particularly vulnerable to the effects of inflation. They may not have the same economies of scale as larger businesses and may not be able to pass on higher costs to consumers as easily. As a result, they may be forced to absorb the cost of inflation, which can put their profitability and even their survival at risk. Inflation can also have a significant impact on retirees and those living on fixed incomes. These individuals may have limited options for increasing their income, and rising price can erode their purchasing power over time. This can be particularly challenging for older adults who may have higher healthcare costs and other expenses. Economists continue to debate the optimal level of inflation as well as the best policies for managing inflation. Some argue that a low, stable rate of inflation is desirable as it can encourage spending and investment while minimizing the risk of economic instability. Others argue that inflation should be kept as close to as zero as possible, as any increase in prices can hurt consumers and reduce economic welfare. Regardless of the optimal level of inflation, it's clear that inflation is a critical issue that affects all of us. By staying informed about the latest trends and developments in inflation, we can make informed decisions about our investments, our spending, and our financial planning. And by working together to manage inflation and promote economy stability, we can create a brighter future for ourselves and for our future generations. One of the most noticeable effects of inflation is the increase in prices that consumers experience. As prices for goods and services rise, consumers may find that they have to spend more to maintain their standard of living. This can lead to reduced purchasing power and in some cases can even make it more difficult for people to afford basic necessities. Inflation can also affect specific industries, such as the energy industry. When the price of oil and other forms of energy rise, this can lead to higher price for gasoline, heating oil and other energy products. This in turn can increase the cost of transportation and production for businesses, which can then be passed on to consumers. Inflation can also affect financial markets and investments. When inflation is high, investors may demand higher returns on their investments to compensate for the reduced purchasing power of their money. This can lead to higher interest rates, which can make it more expensive for businesses to borrow money and invest in new projects. It can also reduce the value of fixed income investments, such as bonds, as the interest payments may not keep up with the rate of inflation. Inflation can also affect personal finances, particularly when it comes to savings and retirement planning. As the value of money erodes over time, individuals may find that their savings are worth less than they thought they would be. This can be particularly challenging for those who are approaching retirement, as they may have less time to make up for any shortfalls in their savings. Despite these challenges, it's important to remember that inflation is not always a bad thing. In fact, some level of inflation is generally seen as healthy for the economy. It can encourage spending and investment, which can lead to increased economic growth and employment. It can also help to reduce the burden of debt over time, as the real value of debt decreases as inflation rises. However, it's important to strike a balance between inflation and economic stability. Too much inflation can lead to economic instability, social unrest, and reduced economic growth. Too little inflation can lead to deflation, which can be equally problematic. This is why central banks and governments around the world work to manage inflation through a range of policy tools and interventions. By using tools such as interest rates, money supply, and fiscal policy, they can work to maintain a stable level of inflation that supports economic growth and stability. Ultimately, it's up to all of us to stay informed about inflation and its effects on the economy and society. By staying informed, we can make informed decisions about our personal finances and investments. And by working together to manage inflation and promote economic stability, we can create a brighter future for ourselves and for our future generations. In conclusion, inflation is a complex economic concept that can have both positive and negative effects on the economy. While it can encourage spending and investment, it can also lead to economic instability and social unrest. By understanding the causes and effects of inflation and by taking proactive steps to manage it, we can help to protect our wealth and ensure a more stable economic future for ourselves and for future generations. A credit card is a financial tool that allows you to borrow money from a bank or other financial institution to make purchases. When you use a credit card, you are essentially taking out a loan from the issuer, which you are required to pay back with interest. The amount you can borrow is determined by a credit limit, which is based on your credit score, income, and other factors. Your credit score is a number that represents your credit worthiness. It's based on factors like your payment history, amount of debt, length of credit history, and types of credit you have. The better your credit score, the more likely you are to be approved for a credit card with a higher credit limit and better terms. When you use a credit card to make a purchase, you are required to pay back the money you borrowed, along with any interest or fees. If you pay your balance in full by the due date, you will avoid interest charges. But if you carry your balance, you will be charged interest on the unpaid amount. The interest rate or APR varies depending on the card issuer and your credit worthiness. In addition to interest charges, credit cards may also come with other fees, such as an annual fee, balance transfer fee, cash advance fee, or late payment fee. It's important to read the terms and conditions of any credit card you're considering to understand the fees and how they could impact your finances. Now let's talk about rewards. Many credit cards offer reward programs that allow you to earn points, miles, or cash back on your purchases. These rewards can be redeemed for travel, merchandise, statement credits, or other perks. Some cards offer higher rewards for specific categories such as dining, gas, or travel. To maximize your rewards, it's important to choose a credit card that aligns with your spending habits and rewards preferences. You should also consider any fees or interest charges, as these can offset the value of the rewards you earn. And always pay your balance in full to avoid interest charges, which can quickly outweigh any rewards you earn. One of the benefits of using a credit card is that it can offer protection for your purchases. Many credit cards come with purchase protection, which can reimburse you if an item you purchase is damaged or stolen. Some cards also offer extended warranty coverage and price protection, which can help you save money on big ticket purchases. Another benefit of using a credit card is that it can help you build credit. By using your card responsibly and making on-time payments, you can establish a positive credit history, which can help you qualify for better interest rates on loans, mortgages, and other financial products in the future. However, it's important to use credit cards responsibly and avoid carrying a high balance or missing payments, as this can negatively impact your credit score. It's important to note that using your credit card to withdraw cash, also known as a cash advance, can be expensive. Most credit card issuers charge a cash advance fee, which is typically a percentage of the amount you withdraw, plus a higher interest rate than the regular APR. If you need cash, it's generally better to use a debit card or withdraw cash from your bank account rather than using a credit card cash advance. When applying for a credit card, it's important to choose a card that aligns with your financial goals and spending habits. Consider the interest rate, annual fee, reward programs, and any other fees or benefits that come with the card. It's also important to read the terms and conditions carefully to understand the fine print, including any penalties for late payments or other infractions. Finally, it's important to use credit cards responsibly and avoid falling into debt. Always pay your balance in full by the due date to avoid interest charges, and don't spend more than you can afford to pay back. You can also use budgeting tools to track your expenses and ensure that you are living within your means. Another important aspect of using credit cards responsibly is regularly checking your credit report to ensure there are no errors or fraudulent charges. You are entitled to one free credit report per year from each of the 3 major credit report agencies, which you can request at annualcreditreport.com. By reviewing your credit report regularly, you can ensure that your credit history is accurate and that you are not a victim of identity theft or fraud. It's also important to be aware of credit card fraud and take steps to protect yourself. If you notice any unauthorized charges on a credit card statement, report them to your card issuer immediately. You can also set up fraud alerts or freeze your credit to prevent unauthorized accounts from being opened in your name. Finally, it's important to stay on top of your credit card payments to avoid late fees and damage to your credit score. You can set up automatic payments or reminders to ensure that
you never miss a payment. If you're struggling to make your payments, contact your credit card issuer to discuss your options, such as a payment plan or hardship program. In addition to reward programs and other benefits, many credit cards offer travel perks such as travel insurance, rental car insurance, and airport lounge access. Before you travel, check your credit card benefits to see what's included and how to access them. This can save you money and provide peace of mind while you're on the go. Lastly, credit cards can be a convenient and secure way to make online purchases. Many credit cards offer fraud protection and purchase protection, which can protect you in the event of a fraudulent charge or a faulty product. However, it's important to only shop on secure websites and avoid sharing your credit card information with untrustworthy merchants. Credit cards can also be used for charitable giving. Many credit card issuers offer cards that donate a portion of your purchases to a specific charity or cause. This can be a great way to support causes you care about while also earning rewards or other benefits. Another advantage of using a credit card is that it can save you time and hassle. Instead of carrying cash or waiting in long lines at a store, you can simply swipe your card or use contactless payments such as Apple Pay or Google Pay. This can save you time and make your shopping experience more convenient. Many credit cards also offer mobile apps that allow you to track your purchases, set up alerts for transactions or balance updates, and manage your account from your smartphone. This can make it easier to stay on top of your spending and avoid overspending or fraudulent charges. Another benefit of using a credit card is that it can offer purchase protection, which can help you avoid losses if your purchase is lost, stolen, or damaged. Some credit cards also offer extended warranties or price protection, which can provide additional value and protection for your purchases. While using a credit card at a restaurant, it's important to keep track of your receipts and ensure that the correct amount is charged to your card. Always check your receipt before signing or entering your PIN, and be aware of any additional charges such as gratuities or service fees. When making a large purchase with a credit card, consider using a card that offers a low or 0% APR introductory period. This can allow you to spread out your payments over several months without accruing interest. However, be aware of any fees associated with this type of financing and make sure you can afford the payments before making the purchase. Credit cards can also be used for entertainment purposes, such as buying concert tickets or booking a vacation. Many credit cards offer rewards or cashback for these types of purchases, which can provide additional value and savings. When using a credit card to buy gas, be aware of any additional fees or surcharges that may be added by the gas station or credit card issuer. Some credit cards offer rewards or cashback for gas purchases, which can make this type of spending more rewarding. Credit cards can also be used for subscription services such as Netflix or Spotify. By using a credit card, you can set up automatic payments and avoid the hassle of remembering to pay your bill each month. However, be aware of any annual or monthly fees associated with these services and make sure you can afford them before subscribing. Lastly, credit cards can be used to make charitable donations. Many credit card issuers offer cards that donate a portion of your purchase to a specific charity or cause. This can be a great way to support causes you care about while also earning rewards or other benefits. In conclusion, credit cards can offer many benefits if it's used responsibly. They can help you build your credit score, earn rewards, provide purchase protection, and make your shopping experience more convenient. However, it's important to remember that credit cards can also come with risks, such as high interest rates and fees, and can lead to overspending if not used carefully. To use credit cards responsibly, always make your payments on time and in full to avoid accruing interest charges. Keep track of your spending and stay within your budget to avoid overspending. Be aware of any fees or charges associated with your card and make sure you understand the terms and conditions before signing up. If you are struggling with credit card debt, there are options available to help you manage and pay off your balances, such as balance transfer or debt consolidation loans. It's important to seek help and advice from a financial professional if you are having difficulty managing your credit card debt. In summary, credit cards can offer many benefits and conveniences, but it's important to use them responsibly and make informed decisions. By understanding the risks and rewards of credit cards, you can make the most of your card while also protecting your financial well-being. Do like and subscribe to our channel. Thank you for watching, and we hope you found this video helpful.
When you buy a home, you have the freedom to customize it to your liking. put down roots in the community, and build equity over time. Plus, owning a home can be a valuable investment that can appreciate in value over time. Of course, buying a home also comes with its own set of challenges. For one thing, it can be expensive. You need to come up with a sizable down payment, pay closing costs, and budget for ongoing expenses like property taxes, maintenance, and repairs. You'll also need to have a good credit score and steady income to qualify for a mortgage. And once you buy a home, you're responsible for all the repairs and upkeep yourself. But if you are ready to take on the responsibilities and expenses of home ownership, it can be a very rewarding experience. Now, let's take a look at the other side of the coin. Renting a home or apartment is often the preferred choice for people who want more flexibility and less responsibility. When you rent, you can move around more easily, try out different neighborhoods, and avoid the hassle and expense of home maintenance. Plus, many rental properties offer amenities like gyms, pools, and on-site maintenance services. However, renting does come with its own set of drawbacks. For one thing, you don't build equity or invest in property appreciation. You're also subject to the whims of your landlord, who may increase your rent or decide not to renew your lease. And while rental properties can offer amenities, they can also be noisy, impersonal, and subject to the rules and regulations of the property management company. So, which one is the better choice for you? Ultimately, it depends on your personal goals, financial situation, and lifestyle preferences. If you are ready to put down roots, build equity, and take on the responsibilities of home ownership, buying a home may be the right choice for you. If you value flexibility, mobility, and less responsibility, renting may be the better option. And of course, there are always the option to a little bit of both. Renting for a few years while you save up for a down payment, or renting out your home when you need to move away temporarily. One important factor to consider when deciding whether to buy or rent is your financial situation. Owning a home can be a significant financial commitment with expenses that extend beyond the monthly mortgage payment. In addition to the down payment and closing costs, you'll also need to budget for property taxes, homeowners insurance, maintenance, repairs, and upgrades. On the other hand, renting typically requires a smaller upfront financial investment, with the landlord responsible for most maintenance and repairs. However, over the long term, owning a home can often be a more financially advantageous choice. While renting may seem cheaper in the short term, home ownership can build equity, which can lead to financial gains down the road. For example, if your home appreciates in value, you could sell it for a profit or take out a home equity loan to finance other investments or expenses. Another factor to consider when deciding between renting and buying is your lifestyle preference. If you enjoy having a yard, a garden, or a space to entertain, owning a home may be the better option. Home ownership can provide more space and privacy, and allows you to personalize your living space to your liking. Or on the other hand, if you prefer a more low maintenance lifestyle with amenities like a gym or a pool, renting may be the better choice. Renting also provides more flexibility to move around as needed without the hassle of selling a home. Location is another important consideration when deciding whether to rent or buy. If you are looking to live in a particular neighborhood or community, it may be more affordable or accessible to rent rather than buy. Renting can also give you the chance to test out different neighborhoods before committing. Renting can also give you the chance to test different neighborhoods before committing to a long-term investment. On the other hand, if you have a specific type of home or property in mind, owning may be the better option. Buying a home can allow you to invest in a specific neighborhood or community and provides more control over the property and its features. When it comes to buying a house, it's important to have a good understanding of its home buying process. This can include researching different neighborhoods, working with a real estate agent, and getting pre-approved for a mortgage. Pre-approval involves submitting your financial information to a lender who will then determine how much money you can borrow and at what interest rate. This can give you a better idea of what you can afford and help you narrow down your research to homes within your budget. Working with a real estate agent can also be a helpful step in the home buying process. An agent can help you find homes that meet your criteria, negotiate with sellers, and provide guidance on the paperwork and legal requirements involved in the home buying process. When choosing an agent, be sure to do your research and find someone who is experienced, knowledgeable, and trustworthy. Once you have found a home you are interested in, it's important to have a thorough inspection done
to check for any potential issue or needed repairs. This can help you avoid costly surprises down the road and ensure that you are making a wise investment. You may also want to consider getting a home warranty, which can provide coverage for a certain repairs and replacements in the first year of home ownership. No matter which option you choose, buying or renting your home is a big decision that requires careful consideration. By weighing the pros and cons, doing your research, and seeking guidance from professionals, you can make an informed decision that aligns with your financial and lifestyle goals. Thank you for watching and happy house hunting. Another important factor to consider when deciding between buying or renting is the current state of the housing market. In a buyer's market, there may be more homes available for sale and prices may be lower, making a good time to buy. On the other hand, in a seller's market, there may be limited inventory and high demand, which can drive up prices and make it more difficult to find the right home at an affordable price. It's important to keep an eye on market trends and consult with a real estate agent to help you navigate the market. Another aspect to consider is the potential tax benefits of home ownership. Homeowners may be able to deduct mortgage interest, property taxes, and certain other expenses on their federal income tax return. This can help offset some of the cost of owning a home and make it a more financially attractive option. It's also important to consider your long-term plans when deciding between buying or renting. If you plan to stay in the same location for several years or more, owning a home can provide more stability and give you the opportunity to build equity. However, if you're not sure how long you'll be staying in the same place, or if you may need to move or work or other reasons, renting may be a better option. One important consideration when deciding whether to buy or rent a home is the upfront cost involved. When you buy a home, you'll typically need to make a down payment, which can range from 3% to 20% of the home's purchase price. You'll also need to pay closing costs, which can include fees for the mortgage, appraisal, inspection, and title search, among others. These costs can add up quickly and make it more difficult to afford a home upfront. When you rent a home, you may be required to pay a security deposit of first and last month's rent upfront. While these costs can also add up, they are typically less than the upfront cost of buying a home. However, it's important to note that while renting may be cheaper upfront, you won't be building equity in the home like you would if you were buying. Another factor to consider is the ongoing cost of owning or renting a home. When you own a home, you will be responsible for mortgage payments, property taxes, insurance, and maintenance and repairs. While these costs can vary depending on the size and location of the home, they can add up to a significant amount over time. On the other hand, when you rent a home, you will typically only be responsible for your monthly rent and utilities. When deciding between buying or renting, it's important to weigh these ongoing costs against the potential benefits. For example, while owning a home can be more expensive upfront and over time, it can also provide more stability, a sense of pride of ownership, and the potential to build wealth through equity. Ultimately, whether you choose to buy or rent a home will depend on a variety of factors, including your financial situation, lifestyle preference, long-term plans. By weighing these factors and seeking guidance from professionals, you can make an informed decision that is right for you. Finally, it's important to take into account your personal preferences and lifestyle. For example, if you enjoy do-it-yourself projects and home renovations, owning a home can provide you more opportunities to personalize your living space and make improvements over time. However, if you prefer a more hands-off approach and don't want to deal with the upkeep and maintenance of a home, renting may be a better fit. In summary, there are many factors to consider when deciding between buying or renting a home. These include your financial situation, lifestyle preferences, location, the current state of the housing market, tax benefits, long-term plans, and personal preferences. By weighing these factors and seeking guidance from professionals, you can make an informed decision that is right for you. No matter which option you choose, remember to do your research, consult with professionals, and make an informed decision that's right for you. Like and subscribe to our channel. Thank you for watching and happy house hunting.